We all remember that day when the vaccine was announced and nearly all shares just rocketed compared to where they'd been. So people who stayed invested were there to benefit from that upswing. So what I'm trying to say here is, yes, things do come down, but over time, generally, they do go back up again.
This episode is sponsored by Saxo Markets. Welcome to the Investing Insiders podcast, where we help you achieve financial well-being by making smarter money decisions. I'm Brianne.
And I'm Antonia.
And in this episode, we'll be digging into ISAs and how they can help you build wealth. Joining us today is Charlene Young, a senior pensions and savings expert from AJ Bell. Charlene, we're delighted to have you on the show.
Thanks for asking me. Delighted to be here.
So ISAs, or individual savings accounts, are a tax-efficient way that people can save or invest. Before we get into, the nuts and bolts about what people can look out for and strategies they can use, could you give us a bit of an overview about how they work and why they're such an important tool for people today?
Yeah, like you say, ISA stands for individual savings account. And the real magic about these accounts is that they are tax-free. You might hear them referred to as wrappers. We do love a bit of jargon in financial services, don't we? But the magic of that is that any investments or cash that you hold within this wrapper is protected from income tax and capital gains tax. And again, the kind of second bit that we love about ISAs is that you can generally get your hands on your money when you need it. And we did some research recently that shows there's nearly £1 trillion worth held in ISAs across the UK now. They've been going since 1999.
That's huge. and I guess a lot of that would be split between, the different types of ISAs, which we'll dig into a bit later. One of the things that has come up recently is the idea of people stockpiling cash within their ISAs. And we've had sort of a recent policy change announced in the last budget where that 20,000 tax-free cash allowance is going to fall. What kind of things can people prepare themselves with that allowance change coming up?
Yeah, so I think the first thing I'd point out is that every adult in the UK gets £20,000. As you say, you can spread across different types of ISAs. The plan is from the government that from the 6th of April 2027, that for anyone under 65, this amount of new money that you can put in each tax year is going to be restricted to £12,000. So existing cash ISAs that you have won't be affected by this change in terms of how much you can put in because that money is already in the wrapper. There are a couple of things to note with this. So it's not just potentially that lower allowance. There's likely to be a ban on transferring, so moving existing cash investment ISAs, I should say, to cash ISAs to kind of circumvent that lower allowance. And, if people are seen to be blatantly kind of trying to game the new rules, there's a chance that certain cash-like investments that have become more popular in recent years might come under the microscope too, although we don't have the final rules on that. So, I think that with anything where something's going to be restricted or cut, there's a temptation to sometimes buy now while stocks last, particularly for people who really don't want to invest. But, the government's trying to do this to try and get more people in the UK to get the benefits of investing, which largely are over the long term, growth over and above the rise in the cost of living. So what we call inflation. Sorry, frog in my throat there. I'm not convinced, and us at AJ Bell, we're not convinced this policy is going to actually help achieve that aim. So we did some research amongst our customers and ISA holders and externally that showed that people who want to stay in cash or want to pile into cash ISAs will continue to do so. They'll either move to something like premium bonds or to other cash accounts outside of ISAs and then potentially face a tax bill for holding their cash rather than actually move to invest, which is what the government wants. I think, focused on education and education of the benefits of investing that we know and we love in the work that we do, or other forms like abolishing UK stamp duty, have a better chance of achieving the policy aim. So I think, the main thing I point out, this doesn't affect money you already have in cash ISAs, but, don't be tempted just because it's going to be restricted to focus everything on cash, because you might be missing out on the benefits of investing.
In what circumstances is it the right move to have your money in cash? Like, who should be utilising the cash ISAs?
Yeah, absolutely. I think, there's a rule of thumb that before you think about getting investing, make sure that everything's in order in terms of your finances, especially a cash buffer or an emergency fund. So cash ISAs are great for this, as long as you can get your hands on that money pretty much instantly. So you're not tying it up in a fixed term type account. So everyone's different. I would say the general minimum rule of thumb is to keep 3 months worth of your spending in cash. So by all means, you could do that in a cash ISA if you can get your hands on it. I think one thing we've seen as interest rates rose in recent years was actually the gap between the interest rate you could get from a cash ISA and a non-ISA cash account has converged. And actually, if you look at Best Buy tables, cash ISAs are currently sitting above those non-cash ISA accounts. So what does that mean? Well, actually, because of the ISA wrapper, the interest you get on that cash in an ISA remains tax-free. So if you are holding larger balances of cash, you might be looking at an ISA to protect that. But, the government is concerned rightly that not enough people in the UK are getting the benefits of investing. So it's about striking that kind of right balance. Investing, as we say, is for the long term. So money that you need within, I would say, 4 to 5 years. Yeah, that's probably not the right thing to be putting that in the stock market, because as we've seen recently, they can go down as well as up over the long term. So in the short term, obviously history shows that generally investment markets do outperform inflation over the long term, but it can be a bumpy ride in some cases.
You mentioned just a minute ago about some of the, I think it was, you were referring to money market funds, were you? When you were saying about, the people holding cash.
Of the cash-like investments. Yeah, as an example of something that's become a little bit popular. A
lot of people don't really understand about those. Could you explain that in a bit more detail?
Yeah, so a money market fund, and kind of try and keep it quite simple,
don't use any jargon, because I think this is where people become unstuck. And we all, I mean, when you work in finance, you're so used to all of that terminology, but it completely throws people off.
Yeah, exactly. I mean, they won't be for everybody, because there is still an element, a small, albeit small element of risk compared to a pure cash account, if you like. So money market funds are where an investment institution tries to manage cash and what is known as short-term securities. So again, a little bit of a jargon term, but different notice accounts in order to chase higher rates of interest. So that's all wrapped up in a fund. And the theory is it's a lot lower risk than going to something like the stock market, but you're aiming to get a slightly higher rate of interest than you would if you just had the money in a bank. So the investment fund that's managing this for you will try and make sure that people can get hands on their money when they need to, because that's really important to some people. But really, they are that kind of first step into investment rather than pure cash.
Okay, so do you think that they're a good way for someone to get started in investing?
Potentially, if that thought of losing money or seeing your investments go down from one day to the next really, really does bother you. But I think the most important thing for me is that people do get invested in. The stock market does give you the best chance of beating inflation over the long term. People might feel safe staying in cash because they don't want to see that day-to-day movement in the value of their accounts. But really, something like the stock market, rather than keeping everything in a money market fund, is the best way of beating inflation over time.
So do you think that people are resistant to investing because they're worried about the risk and losing all their money? Or do you think it's just because they don't know how?
I think it's a combination of both. I think as a nation, we have tended to favour holding larger balances in cash and also other types of investment. For example, people in the UK, we love bricks and mortar property, for example. So I do think it's a mixture of both. I think we could do a lot better in the industry to try and help educate people in the benefits of investing, to get rid of jargon. I mean, we are all guilty of it. As much as we try our best to not use it, I think that definitely puts people off. And I do think there is this myth that people think you already have to be wealthy to then start investing. So they tend to try and stockpile cash for whatever reason. And obviously, rates have been better in recent years. We have seen that flight to cash ISAs in particular, the rates were in the doldrums, years and years ago. So yeah, I think there's a lot of work to be done, whether that's in educating on the benefits of investing, which is something, we try and do and we would love to see more of, so that people do get invested rather than this kind of tinkering with cash ISAs. And one of the things, going back to our question on what's great about ISAs, is they are relatively simple in that whole kind of universe of investing in different accounts. People like ISAs. The reason we've got that £1 trillion almost in there in the UK is because they are relatively simple. There is a fixed amount you can put in each year and you can get your hands on your money. So, there are things out there to help people kind of take that first step into investing in terms of different funds and solutions.
I mean, so one of the things that we sort of hear a lot of is people go, "Oh yeah, it's fine, my money's in an ISA," but the danger there is that doesn't necessarily mean that your money's working hard. So, because obviously not all ISAs are created equal.
No.
So, what do you think people should look out for? It's tax efficient, obviously, being in an ISA, but it's not always efficient in every other way. So just what would you advise people if they're sort of looking for an ISA? What should they be looking out for?
Yeah, I mean, it's no surprise that we love the benefits of investing, and we'll sing about those. So at the moment, we've talked about tax benefits, but actually we've looked at the benefits of investing over cash over the long term. So, we've all become acutely aware of the cost of living crisis. Lots of people who might not have really understood what inflation was a few years ago, we're now all painfully familiar with what it means. Prices going up year on year means our money can buy less of what it did the year before. And that's one of the things with keeping money for the long term in cash. So we went back and looked at ISAs since 1999. And if you'd invested £1,000 or saved £1,000 each year into a cash ISA, it would be worth, on average, £36,290 today. So that's using kind of the average cash ISA interest rate. If, on the other hand, that £1,000 a year had gone into the average global investment fund, I'm sure we'll touch on what investment funds mean in a second, but buying the average fund that lets you buy into global stocks and shares, that would be worth over £92,000. So a difference there of over £56,000. I think that's the crucial point. Of course, investment markets don't move in a lovely, uniform, straight line. They do go up and down, and they can be volatile in the short term. But really, that's £56,000 worth of returns that someone might have missed out on over the last 26 years.
It's a huge difference between the two, like quite a startling difference, and something that we do try to highlight quite often. I suppose to somebody that might be hearing those figures and thinking, wow, I really want to make my money work harder. What are some of the simple steps they can do to, maybe start taking steps towards that? And what type of accounts could they start looking at, and what types of assets? So the things that you can invest in to make your money grow, what types of things could they try to start looking at, which don't necessarily take too much research time, but could help them build that return over time?
Yeah, absolutely. So when we talk about investment ISAs, officially they're called stocks and shares ISAs. And then within that, you pay cash into those accounts, and then you need to choose where that's going to be invested. And Brianne, you touched there on different types of assets. So when we talk about that, we just mean different types of investments. So company shares, whether that's in the UK or overseas, probably the most simple, more understood version, but also things like bonds, which is where you lend money to a government or another company, or alternatives like gold, been in the news a lot recently, and even a bit of cash or property investment. So for me, I think an investment fund is a great way to start. In particular, something called a multi-asset fund. I'm ringing that jargon bell again, and it's making me cringe inside. But what do we mean by that? We mean a fund that invests in lots of different types of assets. So the idea here, I always think of a fund as a kind of shopping basket or a shopping trolley of investments. So a fund might be spread across different types of investments, such as just UK shares, for example, or a multi-asset fund is where you have a bit of each of these different types that we've talked about. So you are leaving the investment decisions, so the individual investment decisions, to the fund manager of that fund. So they're a great way for people to get started if you want, I would say hands-off approach, but you can still see what the holdings are of that fund. And the great thing about these types of ready-made funds, if you like, is that they often come with handy labels for you to understand what types of investments they're going into, what the mix is. And that's important because they might be able to help you match that to your risk appetite. So what does that even mean? That means how you would feel if the value of an investment went up or down on a day-to-day basis, if you like. So you can get funds that might have a label, something like adventurous, which normally means they have a higher weighting to shares, sometimes up to kind of 80%, maybe even more than the fund of than that, with less in things like bonds and cash. Or as you move down that kind of risk scale, you've got balanced, which traditionally has been around 60% in shares. Just the idea is that you don't have all your investment eggs in one basket. So if at the moment, the times that we're living in right now, maybe shares are a bit up and down throughout each day, a bit more volatile than they are normally, the idea is that the other assets in your fund, so the cash and the bond element, don't behave in exactly the same way. And you are helping to kind of smooth the risk of your investment fund. So, plenty of investment platforms have ready-made funds or sometimes they might call them starter funds or portfolios that help you get started. You can choose the weight of the different assets that you want in each fund. Although someone is managing the fund for you, you aren't getting personalized advice. I think that's important to point out. Sometimes I think people think that that's being managed for their personal circumstances. It is up to you to do a little bit of research and review your position, but really you are kind of handing over those day-to-day investment decisions to a fund manager.
So we had a look at some of these sort of ready-made investments that you're referring to here, and some of the performance over the last sort of 5, 10, 15 years. And the adventurous funds, people are asked to assume more risk in exchange for the possibility of better returns. And in our analysis, we did actually find that those adventurous funds were coming out on top in terms of returns. So I suppose for people, the difficulty is that when you've got limited investment knowledge or limited knowledge of how these things work, you're kind of tempted to just go for what you think is going to grow your money the most. But who do you think should avoid those kind of adventurous funds, and when is it a good idea?
Yeah, so I think when we come to these terms like adventurous and balanced, it's how you feel and how you might behave if you saw your investments go down in value as well as up. It is that kind of volatility, but really most of us are concerned with when these investments might go down in the very short term.
Yes,
of course,
it's nice when they go up.
Of course it is, and like you say, the people who tend to have more allocated to company shares, for example, over the long term are getting the investment wins, but the journey, that kind of investment journey, day to day, month to month, might be a lot more bumpier than what we might deem a lower risk fund. So if the thought of your money going down and up every day, sometimes by quite big measures, when you get big shocks or banking crisis, the war in the Middle East, if that is going to keep you up at night, then a fund labeled adventurous perhaps isn't going to be the one for you. But the kind of trade-off over the long term is that although you'll get a smoother ride, in theory, you might not get those kind of higher returns that you guys have found in your research. So it's about how you might behave. And, one of the most important things to do, especially in times like at the moment where you might see things going down, or you might hear headlines about the FTSE is down or this is down, the oil price is getting really, really high. What does that mean for me? Investing is for the long term. And it's about trying to stay that course once you've invested that money, unless you really, really need it, which, we're talking about investing for sort of 5 years plus here. It's about kind of trying to keep your nerve. And that's not to downplay that it's really unsettling for people, some of the headlines at the moment, and I totally understand that. But really, there's an old saying, and I feel quite old using it, but it's time in the market that counts, not timing the markets. And it is one I always do go back to. So yeah, adventurous funds, if you really think that's going to cause you anxiety and worry, then look at something perhaps lower down the risk scale, but be aware that a smoother ride sometimes means lower overall returns.
So do you think that now is a good time for people to start investing? Because you've just talked about that volatility in the Middle East and how the markets are reacting. And we see a lot of people going, get in now while people are fearful, you should be brave, and all of these sort of sayings. What's your opinion on that?
Yeah, I mean, a lot of the headlines at the moment will be concerned with the oil price and what's going on in the Strait of Hormuz. So what does that mean for us day to day? So it's changed the expectations for what might happen to inflation. And with the Bank of England meeting this week, it's pretty nailed on now that they're not going to reduce interest rates when we thought they would be. And we were, thinking that might happen 2 or 3 times this year. Like I say, it can be unsettling, but there is, the people saying get in now do have a point. So I think my first thing would be keep calm, because if you don't sell up, you'll avoid locking in any losses. But if you're making regular investments or you're thinking of investing a lump sum for the first time, investing when markets have gone down means you'll be buying more investments because they're actually at lower prices. So that gives you an extra chance of getting the benefits of investing overall, but also being there for any upswing and any growth that does happen. And, we've seen it throughout recent history as well. After the pandemic, people who did stay invested, yes, they would have seen an immediate drop on paper. But if they didn't cash in those losses and didn't lock them in, we all remember that kind of day when the vaccine was announced and nearly all shares just rocketed compared to where they'd been. So people who stayed invested were there to benefit from that upswing. So what I'm trying to say here is, yes, things do come down, but over time, generally, they do go back up again.
This episode of the Investing Insiders podcast is sponsored by Saxo Markets. Saxo provides access to a broad range of global assets through a sophisticated trading platform. You can trade US stocks from as little as $1 per trade and UK stocks from $3 per trade. Please remember that all investing involves risk. The value of your investments can go down as well as up, and you could get back less than you invest. Terms and conditions apply. Visit Saxo Markets to learn more. How often should you be checking in on your investments, especially if you've gone for something ready-made, so it's, almost taken care of for you? Is now the time to kind of just turn away and just think, okay, it's all going to be fine and balance itself out? Or should you actively be checking, X amount of times to make sure that things are on the right track?
This is the point where I should practice what I preach, I think. So if it's going to cause you anxiety and you're going to worry, it's best not to actually just constantly watch your accounts. So if you're in something like a multi-asset or a ready-made fund, they tend to change price once a day, once a working day when markets are open. If you're in something like an individual company share, the value of that can actually change throughout the day. So if you're constantly checking your account, particularly something like that could really cause you some worry when times aren't so good. So I think if you're invested for the long term and you've gone into your fund, whether that's balanced, adventurous, or labeled otherwise, really, I don't think you should be reviewing or changing that investment unless what we call your investment case has changed. So if your circumstances, your wider circumstances haven't changed, there's generally not a need to change your investment strategy. By all means, I think checking in at least twice a year is a really good thing to do. Let's be realistic. Most of us are checking at least once a month, if not a little bit more right now. But it's about kind of managing those emotions and just reminding yourself why you're invested. And this is hopefully a very short-term blip, and hopefully things will, take a turn and then turn for the better.
Well, I mean, historically, the markets have always recovered. So, to this point, we have a junior ISA for my junior stocks and shares ISA for my son. And I just shoved it all in an all-world tracker fund. I use it a lot as an educational tool. So I'm showing him quite a lot at the moment because I want him to experience the dip so he can experience the recovery. So when he then takes charge of that account, he has some knowledge in how these things work. Because it can take. I think I read that the average time it takes for the market to recover is 4 months. Am I right there?
I would say that probably is a sensible average. And actually, over the course of things, that's not actually that long. It might feel like a long way off right now. We don't know what's going to happen tomorrow and how long this particular crisis is going to go on for. But yeah, I think that's a really good way of looking at it. I'm quite passionate that we talk to our children who we have junior ISAs for. I also have one for my 2 children. They're quite young at the moment. My eldest is just at that age where I can talk to him about what investing means and different companies. So to try and explain shares, for instance. So yeah, that's a really good way of thinking about it, actually showing them that things do go down as well. But if we give people a little bit of ownership and, they're invested literally in their own junior ISAs, when they come to turn 18 and they can get their hands on the money, we've seen it in our own accounts that actually 1 in 3 of our junior ISA holders actually put more money in once they get hold of the money as an adult ISA. So,
well, I think once you've experienced it and you've seen how it works and you see how it grows, it actually becomes quite difficult to take your money out because you don't want to stop the growth. And so you're like, no, I'll do anything else before I'll withdraw from my stocks and shares ISA. So it actually, I think when it comes to a junior ISA, it helps quite a lot to stop kids from having that sort of lottery moment at 18 where they go, oh, I didn't know that was there. Happy days. Let's go and, I don't know, have a massive party.
But, well, personal view, but I don't personally agree with the people who sort of keep it secret, because I just think that's storing up trouble. And there's a lot of people who say, well, I'm glad I didn't have that, because when I turned 18, I would have just spent it. I think we're slightly guilty of maybe projecting our own behavior in the past or potential behavior onto the next generation.
Yeah. I mean, because they're missing that element of education in terms of investing and ISAs and things like that. I mean, when I opened my first ISA, I probably didn't really fully understand what was going to go on in it. It was just a buzzword. And if you were being financially responsible, you had an ISA. So I think it does help for parents to involve children in it all. Are you seeing, just to circle back to the conversation about cash ISAs, we're in the penultimate year now the last year where you can put 20k into a cash ISA. Are you seeing AJ Bell an influx into cash ISAs, or is the ratio between stocks and shares ISAs and cash ISAs remaining pretty steady?
So we only offer a stocks and shares or an investment ISA and the investment version of the lifetime ISA. But I think, our customers are paying cash into ISA to then invest it. So, we have spoken to our customers about, particularly their cash ISAs, because lots of our customers invest and then they will put some cash into a cash ISA as well. But I think, for us, our customers are pretty well versed in the benefits of investing. So yes, like I say, there's that temptation to kind of buy now while stocks last. But we have seen flows into ISAs, cash ISAs across the board. If you look at the HMRC statistics, certainly in recent years, we've seen that big flight to cash. Now that interest rates are starting to come down, albeit slower than expected, it'll be interesting to see the next set of statistics. The annoying thing about those HMRC statistics, they're on quite a long lag. So really, when I was talking about that £1 trillion figure and also 15 million people who put new money into ISAs, that's actually from the 2023-24 tax year. So we've got a little bit of a time lag on those statistics from the taxman, sadly.
And what sort of people do you see putting their money into stocks and shares? Is it are the younger generations more likely to invest than the older ones?
It's really a mix. We've been going for sort of 30 years now, so we've got a real mix of kind of experienced investors, people who almost do it as a bit of a hobby. But yeah, people love the simplicity of an ISA, the fact you can get your hands on the money if you need to, albeit we're trying to say investing for the long term. So a real interest across the board from beginners right through to those people who, are well versed in the benefits of ISAs and actually have, they are what we call ISA millionaires because they've reached that kind of huge figure in those tax-free accounts.
I was just about to ask you about ISA millionaires because I think I read something the other day that said that there are more ISA millionaires in the UK now than lottery millionaires.
Lottery winners. Yes, that was my. I think my colleague was to thank for that release. And yeah, it's really interesting. And one thing we do find is whenever we kind of delve into the portfolios of ISA millionaires, what are they buying? What does that look like? What kind of investments did they favor? That's really popular. Whether you're an ISA millionaire yourself or you're someone getting started, just kind of seeing how these people who, like I say, they've probably been at it for sort of 25 years. The ISA allowance is that generous £20,000, particularly if you're all allocating it to investments from 2027. So yeah, no, some really, really interesting sort of research in that area.
So is there any sort of, are there any sort of interesting data points that you can tell us about the ISA millionaires? I mean, what are they investing in?
Yeah, so really favouring kind of your traditional UK stocks. So a lot of people, so not what you might have thought. So your kind of names like your Nvidias, all the kind of tech stocks of recent years, they don't feature as heavily as perhaps you would imagine. So a lot of this cohort will be tending towards the kind of upper ages now, maybe thinking about retirement and what that looks like for them. So a lot of people are investing in those kind of traditional UK stocks that do pay good levels of income. So we talk about dividends here to give it the official term. So if somebody is switching to a point where they're not necessarily saving for retirement anymore, they're actually going to put their money to work for them. They might start to draw an income from it. So there are certain individual stocks that do pay higher levels of income. And of course, the beauty of ISAs is that any income you take from them is tax-free. So yeah, an interesting profile, definitely favoring kind of stocks and shares or investment trusts, which are a different type of kind of fund investments over traditional funds or multi-asset or ready-made portfolio funds. But they do still feature in there.
It's definitely a really interesting mix, and it's been quite interesting to read all of the sort of ISA millionaire stuff that has come up as well. I think one of the points that seems to be pulling through is while time in, the investment market plays a big impact, it's not necessarily too late, because if you can bump up your contributions, that can help balance things out as well. So I guess for people who might be thinking, is it a bit too late down the line to even bother trying investing? What kind of tips would you sort of give to them to just at least give it a try and see how they can fit it into their sort of balances?
Yeah, I mean, I'd say it's never too late, but maybe I'd say that working for an investment provider. But again, it is about as soon as you can get started. Of course, how much you pay in and how much you invest has the biggest impact on what your end return results are going to be. But if you can get started investing as soon as you can, the earlier you get started, the better. As I say, that big myth that you already have to be wealthy to even think about investing, or that it's just for a certain type of person, whether that's age or another profile, that's just such a huge myth. And those are big barriers that we need to break down. ISAs do come with a really generous £20,000 a year allowance. Not everybody uses that. In fact, it's quite rare for somebody to use that consistently year on year. I think the average amount, going back to those statistics from the taxman, that was going into investment ISAs ended up being about £5,000 to £6,000 over a tax year. So, if you don't have £20,000 every year to invest and put away, don't let that put you off either. Investing regularly is a really good way of kind of not only automating your investing, so you don't have to think about it. Lots of platforms have services that do that for you. Your money will be invested, your chosen amount, into your chosen investments on a regular basis on or around the same day each month. So the beauty of that is that, again, it's hands off. You don't have to worry about it. You'll just automatically let that happen. You won't be thinking, oh, should I do that at the moment? Should I wait? It just happens automatically. And that can be a comfort to people because they might benefit from this kind of smoothing of returns. 1 month you're buying when investments are cheaper, so you can buy more with your fixed amount of money. The next month, it might be a bit less if funds have started to recover. So yeah, don't feel that you have to put in that £20,000 and invest it each and every year. Get it started little and often. Time, get the benefits of compound investing as and when that recovery does come, and hopefully you'll be able to see the benefits.
What do you think is the biggest mistake people make?
I think kind of waiting for that right time to get started is probably one of them. We've touched on that already. One thing we do see in the investing area is sometimes if people are moving, so they're transferring from one ISA to another, if you've already got money wrapped up in that tax-free wrapper, you can move it to another type of ISA. Some people try and kind of do that themselves, something called a self-transfer. So they withdraw the money from the ISA and then try and pay it into their new one. That's not necessarily the most common in terms of like frequent mistake, but it can be a pretty devastating financial one, because if you've saved up a decent amount, whether that's in your cash ISA or it's in your investment ISA, you withdraw it to then move the money and pay it into another one to try and do it a bit more quickly, you lose the tax benefits of that ISA. So yeah, it's not something that happens a lot, but when it does happen, you are potentially losing that tax wrapper. Again, I think people thinking that they have to put that £20,000 a year in just for it to be worth it. That's probably my other mistake.
So AJ Bell have got do they offer a transfer deal when people move their ISA into AJ Bell?
So we can obviously help people transfer if people get in touch with us, and then we can help with that process. We don't tend to offer some of the big kind of cashback deals for people to invest and then move their money across to us. Our kind of philosophy is that hopefully our lower costs kind of bear out over the long term, and we don't necessarily need to offer those kind of deals in line with our service. I would need to double check what we have at the moment. I don't think we are actually promoting a deal at the moment, but I don't have details of that.
So if somebody wanted to do this transfer and they contacted AJ Bell, how long does it all take? Like if someone wanted to do it now in time for the reset or the financial reset on April 6th, would it happen?
There's two ways you can transfer investments or ISAs. So you can either sell, let's say you've got a stocks and shares ISA elsewhere, you can sell those investments, keep it in cash, and then the ISA account is transferred over to the new provider. But because that money is already in an ISA, it's not kind of at the mercy of the tax year end date. So when you do transfer money in that way, so you sell the investments with the original provider first, and then we would request the ISA transfer from your old provider, that can be quite quick. That can be a matter of days, like max a couple of weeks, really. However, at the moment, a lot of people are favoring keeping their investments, and if they can be held at the new ISA provider, transferring them in their current form. There's a horrible industry word called in specie, which you might be asked to tick a box if with your existing provider, if that's how you want to do it. And the reason people are doing that is because you don't have to sell the investments. You're not out of the market. The downside of doing it this way is that it does take longer, because the two providers need to talk to each other, make sure that both investments can be held, and then get them transferred across. So if you're talking about transferring existing ISAs, you're not at the mercy of that tax year end. So that's not so much of an issue. The one thing that kind of is at the mercy of the tax year end is if you had existing investments outside of an ISA, so in something called a dealing account or a general investment account, so unwrapped, and you wanted to hold the same investments but in your ISA and do that before the end of the tax year. There's something you can do called a bed an ISA, which is where you sell the investment and then immediately buy it back in the ISA. So the best thing to do there is to do that with your existing provider, just because we are obviously coming up very close to the end of the tax year. You can use your allowance, and then, once you've decided what you want to do with that money long term, you can either move it to another investment ISA provider if you want, or stay where you are.
So I think with, what's been brought up here is a really important point. With the concept of cashback deals, and sometimes you get those really big, flashy transfer offers, what are some of the things people should look out for to make sure that the platform that they might be looking at is the right move, rather than kind of getting caught up with what you might get back?
Yeah. So, obviously cost is a big factor, but it's the total cost that you would be paying for the features you are going to use and the features you're going to value. So, when we look at value, we don't always mean cheapest. As I say, it's about all the features that you want and you're going to want to use. There's no point paying for something in a platform charge or an account charge for a feature that actually is of no interest to you. So absolutely, when you're comparing deals or you're comparing different providers, look at the cost of the account charge, or the platform charge it's sometimes called, the charges for the investments you're considering, whether that's a ready-made fund or a different type of fund. Those funds charges are sometimes called an ongoing cost charge figure, or OCF. So have a look out for those. You might not know exactly what you're going to buy, but you can kind of work out a ballpark figure. And then also look at the charges for dealing. So dealing charges are where every time you buy or sell an investment, you might pay a fee. And those can vary. They're often less if you set up one of those regular investment instructions that we talked about earlier. So if you do that automated investing, you tend to get a pretty good deal on those dealing charges. So yeah, absolutely. Value, it does vary what options you want. But if you're getting started and paying regular small amounts, the costs can have a really big bearing on the kind of end outcome for you. I think also when you're comparing, have a look at what we've called asset allocation before. So that mix of different investment types. If you are considering one of these ready-made portfolios or funds, just double check that the labels kind of are equivalent if you're looking to compare them, because, generally I think those investment labels are pretty consistent across different providers, but, our adventurous fund might look slightly different to one from another provider. Also have a think about some kind of like other considerations. Some people have some governance or ethical considerations when it comes to investing, or want to make sure they're not investing in certain types of companies. So if you are looking to invest more responsibly, have a look at those options as well. So yeah, it's about kind of just trying to do an overall comparison. And obviously, like we say, investing for the long term. So although you might be offered a deal up front, actually over 5, 10, 15 years, what might that look like for you?
Amazing. I think that kind of sums up everything people need to know. I guess if you could leave everybody with one golden ISA tip, whether they're looking for a cash ISA, stocks and shares ISA, what would it be?
Yeah, we've touched on it already, but mine would be get started investing as soon as possible. The right time is now. If you're set up, you've got that cash buffer, get investing as soon as possible, even if it's little and often. And that's the best way to kind of get started on that wealth growing journey.
So would you, in that instance, you're 20 years old, you've got very limited knowledge. Would you go into a ready-made portfolio? Would you go into an index? How would you choose?
There is a lot of choice out there. I think if you were coming to it and you didn't have a breadth of investment knowledge, I think something like a ready-made fund is a really good place to start. Like you've mentioned, passive or tracker investments there. Those are funds that aim to kind of mimic the returns of a certain investment market or index. So, for example, in the UK, we've got the FTSE 100, the biggest 100 listed companies on the stock market in the UK. So, if you see a tracker that fund that's targeting that fund is trying to give you exposure to those companies and for you to benefit from those returns. Those ready-made funds or multi-asset funds will be a different mix. So they won't all be in shares, and certainly not all in the top shares in the UK. So I think, yeah, if I was getting started, going back to that point, I'd probably be favoring kind of a multi-asset type solution. And I think one thing I'd also point out, I know we're talking about ISAs today, but lots of people think that they're not invested. But if you're employed and you are in a workplace pension, chances are you are already invested. So don't think that, you're not ready for it, that you don't know what you're doing. You're actually already probably invested somewhere.
Thanks so much, Charlene. It's been really good chatting to you.
It's been great chatting.
And you both. Thank you so much for asking me.
Thank you so much for joining our Investing Insiders podcast. If you like the episode, please subscribe and leave us a 5-star review on your platform of choice. For the latest money news and deals, you can sign up to our weekly newsletter at investinginsiders.co.uk/newsletter-page. We've also got a suite of guides, tools, and calculators on our website at investinginsiders.co.uk. You can also keep up to date with us on TikTok, Instagram, and YouTube. Thanks for joining us, and we'll catch you in the next episode.